All right, welcome back. As you can see from the card there, Dr. Hassan Mahmud, the Director of Monetary Policy Department at the Central Bank of Nigeria, is with me here at the table. Dr. Mahmud, welcome to the program.
Thank you for having me.
Let's get started. The 10-page communique is not as much as, because I counted now at least since this year began.
Yeah.
I think, was it March? Oh no, was it January? There was more than this one is just 10 pages. Okay. But we'll look at the details, the 10. I want to ask you first, what has changed in the last 8 weeks? The last meeting was in March. Yeah. Yes, between March, the end of March till yesterday. What has changed? Is it same old?
Well, it's not same old.
Okay.
I think generally we are seeing some subdue in some of the shocks that were coming in from particularly the third quarter of 2020. We saw the resumption of some normalcy by the fourth quarter, but that consolidated by the first quarter of 2021. So numbers around inflations, numbers around GDP improved, numbers around capital inflows or capital volatility also improved, numbers around global performance of the international financial system also improved. So we see that coming up, and we see the more reinforced optimism in terms of the global growth numbers, which will also dovetail to the performance of the domestic economy in Nigeria in this case, including trade. Now, the projections of trade at the fourth quarter of 2020 has actually surpassed the pre-pandemic era. So we see those stabilization factors coming in. Regardless, there are still uncertainties in some quarters, but generally we're already coming out of the woods. That is the recession that we had in the second and third quarter of 2020.
Is it that there's an arrangement or there's a meeting amongst the central banks of Africa or in Africa right now, majority of you to be on a hold stance? South Africa held its rate steady last week, I think 3.5%. Some other central banks, I'm not saying some others are not tightening as a result of, they're saying restrictions are reducing in many parts of the world and all of it. Is it that there's a meeting you all are in that will analyze the African economy and say, okay, guys, let's hold?
I think all of them are using, I can say, informed methods or approaches, standard approaches to look at things objectively and according to, the economics and the finance and the politics and all those theories together to see that there were a lot of injections that came into the economy to reflate most of those economies. A lot of them have lag outcome effects in the sense that it takes a while, 2, 3, 4 quarters before you start seeing those things, the expected outcome crystallizing in those economies. We've done that. We've done those huge injections, and then it is time to wait to see what is the outcome of that. Are those working before you start rushing to change those policy tools? In most of the economies, there are quite a lot of signals, both advanced and emerging market economies, that those injections, both fiscal and stimulus, are yielding some expected outcome, but very slowly. So it's important that you just watch, slow down, consolidate on what you have, and keep seeing the new results before you start making any drastic moves, so that you don't distort those little or marginal gain that you're already seeing. I think that's what is informing why everybody is just waiting. There are other tools that are being used apart from the monetary policy rate itself to make some administrative adjustment within the economy. But the key parameter everybody is looking at is there any adjustment in monetary policy rate?
Has the central bank run out of those tools?
Well, we've not really run out of the tools, but I think we've used the tools we have now to their prime. Monetary policy tools are not like structural tools you use for, long-term economic management issues. But at this stage, and the potency of monetary policy tools within crisis, during the crisis period, is also limited. when you overheat the economy, if the fiscal side or other structural parameters are not coming up to speed with these monetary policy short-term tools, then if you overheat with monetary policy tools, then you overheat the outcome of the economy, and that will be more distortionary in the medium to long term than when you have to complement what the fiscal side is doing in terms of infrastructural issues that are supposed to support the growth drive, other supply indicators that are supposed to help in bringing production to the market, so that you don't just start adjusting price parameters thinking that will bring down the price when the supply side is just not coming on board.
From the central bank angle, do you think that you all have supported the market with the monetary tools, at least in the short to mid-term, at least in the last 1 year, since the monetary policy rate has been left at 11.5%? Do you think that that has supported the market sufficiently to attain stability and to also ensure that banks are lending to Nigerians?
I think from the start of the crisis, we adjusted monetary policy downward. That's an indication of expansionary monetary policy. And outside of that, there have been a huge volume of monetary policy injections in terms of monetary policy stimulus, complementing that of the fiscal. So that has been expansionary. The unconventional monetary policy tool has also helped significantly in pushing some of those parameters, because like I said, monetary policy tool efficacy is also a lot limited when there is crisis. And that was this period we experienced in the last 2 to 3 quarters, and which we are still just trying to pull out of. So indeed, yes, monetary policy tool has substantially supplemented or contributed, supported the marginal or moderate recoveries that we are seeing now, particularly in terms of real sector performance and the financial soundness position. You could also see that the resilience of the financial system, which could have also been a very major crisis to compounding the economic growth crisis we are having, if the financial system were also allowed to go under or have a major systemic problem. So the resilience of the financial system to continue to support, if we are doing interventions and all the stuff, we are doing them through the commercial banks or development banks. If those ones are not stable there, then you don't even have that transmission channel to get to the consumers and households and firms in using your monetary policy tools of those monetary stimulus packages. So I think in general that there's been a complementarity between those development in terms of driving the growth outcomes that we're getting now.
What are the long-term policy goals of the CBN, especially around inflation? I know you have a target for yourself, 6 to 9%, but it's not been met. Inflation is at around 17.75% now. So what are the long-term policy goals? That's one. The second question is, what kind of inflation rates will the Central Bank of Nigeria be comfortable with? Not the 6 to 9%, because I don't know when we'll get to that. There are a lot of aspects that we need to have in place, or a lot of things we have to have in place to make us get back to that 6 to 9%. But what kind of inflation rate can the Central Bank of Nigeria be comfortable with now, vis-a-vis the policies of even yesterday on the FX side, vis-a-vis the production gap, the current account deficit which we have, and some other factors? So what kind of inflation rate can you be comfortable in saying, okay, I think we're on the path to recovery?
That will depend on the economic conditions, how they change, and how fast they change. However, it is important to say that the long-run goal will be stable prices, low and stable prices, so that can drive the expected growth we are looking at.
What do low and stable prices mean? That's in fact the cocoa of what I'm asking.
Yes.
What will be comfortable low and stable prices?
There are sometimes you need some level of price movement upward to stimulate growth, to stimulate supply. And there's also sometimes that when you see that the demand side is stifled, you need to bring down those prices, so that the other guy was talking about the purchasing power parity, so that the the power of spending, has, because inflation erodes that welfare effect or that income effect that you get in terms of your earnings and what it can buy, the purchasing power. So if you are in that situation where there's excess of demand and then the supply side is being stifled, you can't start asking for prices. You want prices to go up so that it stimulates that supply side, because the demand is there to push that down after a very short period. But the general goal is just to have a low, stable prices, because even if you have low prices and it's highly volatile, business projections or business plans cannot be executed easily, particularly both the financial system and even outside of the financial system. So you can say single digits inflation number, but that will not be static, like, oh, we want 5% this month and then we have 10% this month. But if it's able, because the mandate is to have stable price stability conducive for economic growth. So it has the flip side. Is the price numbers conducive for growth? Right now it's not conducive for growth. So we need to be working towards bringing that price number down up to the single digit territory that we're looking at. Now, and we also need to compare that with other economies that are your competitors within the trade sphere. So you see that disparity in your inflation numbers, and that will also affect the attraction of inflows to those your economy, because everybody is looking at your inflation numbers against your policy rate or the interest rate that runs in those economies. So we also need to be looking at those inflation numbers compared to our policy rate or the rate of interest within the economy. So long as that is narrowing, we want your rates to be above your inflation numbers so that you have positive real interest rate to attract whether domestic or foreign capital. If
the monetary policy rate at 11.5%, will you still say that, at least with the central bank this is an expansionary rate, that's you all are on an expansionary drive, that means you are dovish, you've taken a dovish stance at 11.5%?
You see, you can look at it from two sides. If you look at it from the financial sector side or the banking system side and what we are doing with CRR, special bill, DCRR, and stuff like that, you see that there are kind of some tightening within the banking sector. So from that side, it is like tightening, to not to allow excess liquidity to, compound inflationary pressures that we're having. But if you look at it from the monetary policy side, for the fact that you reduced rates and you kept it at that reduced position, and you're also making some injections, huge injections into the economy, is still largely expansionary monetary policy to drive growth recovery. Maybe when we get to for the advanced economies like the US now, they are already making indications that by the time they get to a particular level of growth and employment, they're going to adjust their rates. They start
they're crying right
pulling
now
back.
That inflation is high.
It's high, over 2%.
Yes,
yes,
about 5. Okay, yeah, 5.4%.
Yes, 5,
yes, 5.4%
yes.
inflation.
So you
and
see
they are crying.
that, yes, they should be crying because, but
because it will erode their dollar, which is the reserve currency.
Yes, yes, and it's also going to have impact on us when they start normalizing or tapering on this asset buying that they are doing to inject liquidity into the system. If they stop because of the premium, the risk premium globally, you find that investors that are already in our country now or in other emerging market economies will start, carrying back their investments to the US because of the, the stability and the assurances and the low risk premium of those advanced economies. And that will have pressure on our exchange rate, pressure on our external reserves, and you start seeing issues around depreciation. And when we cannot adjust that fast, then we start doing devaluation.
I don't know if you answered the question around the long-term policy goals.
Yes, that's what I said. Okay. The long-term policy goal is low and stable prices.
Okay, so at that point I came in and said, and asked what is actually low and stable prices. Okay. Let's take a look at this area, which is this MPR and liquidity ratio, CRR. I want you to really explain to Nigerians that are watching now the importance of these rates. Explain it to that woman in Okeari right now. Explain it to that young man in Onitsha. and why they should take particular interest whenever you and your colleagues meet.
Talk about this.
Yes. In simple terms, don't give me break it
yes,
down.
yes.
Don't look for those technical economic
No,
terms.
I will not do that. But it's also going to be a big task. But I'll make an attempt. Yes, I think you have softer languages to deal with that, given my own background.
Just say your own
what is
and I'll try
important
and
is,
explain.
The MPR, the monetary policy rate, is supposed to be the anchor rate on which other interest rates are supposed to build, because they call it risk-free rate, the rate at which there is no any risk, and so that will be the 0 point where other banks, because that's the rate between the central bank and the banks, and from that rate the central bank build their lending rate. So any adjustment on that rate, or certain risk variables, is supposed to feed into the money market rates and also the commercial bank rate in terms of lending. So if you adjust that rate downwards, we expect that to translate to the cost of lending, or the lending rates, whether prime or maximum lending rate, and that should feed to increasing credit in the economy so that people can have access to what we call cheaper loan. The liquidity ratio is between the central bank also and the banks, and this comes on the platform of the role of the central bank to manage the liquidity in the system so that liquidity does not impact on the inflation numbers. So when it is the proportion of the commercial bank funds that is kept with the central bank at any particular time. If we increase that liquidity ratio, it means that the proportion of the central bank's liquid asset that will be holding will increase. That means there will be less money with the banks to play around with. And when that happens, you start seeing rates going up in the money market. If we release that to the market by reducing that liquidity ratio, they have more money in the system to also online to the customer. So the general public should be looking at that from that perspective. And then if you look at the last one, which was the CRR, which is tightly related to the liquidity ratio, is also the holdings of the central bank of those proportions of the funds that are with the commercial bank. All these are to manage.
For example, if there's 100,000 naira, the CBN will go 27 naira.
Yes,
27,500 naira.
Yes, of it. Yes,
Because
with us. Yes, in case of some issues. But we have also made provisions now, because these are dictates of economic conditions, where even though CRR, the banks can also assess it. We did the DCRR, and also where banks can, if they need those funds, because they are just idle funds with the central bank earning nothing. But it's better to stay here than leave it in the market there for them to be hitting the exchange rate market or doing other arbitrages that will distort money market rates. So if those banks have projects in the real sectors which have already been identified and there is guideline for you to assess that, they can come to the central bank and take proportion of that to online for those critical sectors that we know are important to drive these growth targets that we have for these post-pandemic initiatives.
Okay, I think it's simple enough.
I think.
Yes, I think you tried.
Yes.
Yeah, you tried to simplify it. Yeah. Now, as we wrap up the program, what other things do you want Nigerians to take away from this communique? The CBN governor said quite a lot of things here. In days to come, we would still look at it, not from me, from independent sources. Okay. So that we'll critique it very well. What other things do you want Nigerians to take away in the last 1 minute that we have?
I think the most important thing is, because a lot of analysis come before MPC meetings and post-MPC meetings. I think what is important is for the general public to know that monetary policy decisions are not based on sentiments. They are not just based on, like you call media trial or something. They are based on core statistics. They are based on, reasonable expectations of favorable outcome for the economy, including driving employment, because that's whether GDP is growing at 50%, so long as it's not creating jobs, so long as the money that people are having in their hands has no value, so long as they don't have access to foreign exchange to do some of the things they want, they just feel that the economic system has failed. So what is important, the takeaway is that decisions of the monetary policy, one, are geared towards achieving these social benefits for the entire economy, including the impact on individuals and households. It's not just theory and CRR and MPR and stuff like that, but how it will impact on the economy, reduce poverty, increase employment rate, and make the standard of living of people better.
Okay, I think we'll leave it at that.
All right.
Thank you very much, Dr. Mahmud. I've been speaking with Dr. Hassan Mahmud, the Director of Monetary Policy Department at the Central Bank of Nigeria. We've been talking about the MPC decisions that was read out by the Central Bank Governor on Tuesday after the meeting. Thank you all for joining us today. Please join us again tomorrow. I will be here, God willing, 11 a.m. to 12 p.m. on this channel. But the best you can be, but that change that you want to see. I am Nancy Naji.